AJ Capital. Today's video will be about low-cost option strategies. Let's say you're broke, your mother cut your allowance off, and you have nothing else to pawn. What are you going to do? Options tend to be cheaper than shares because one option contract represents 100 shares of stock, so it should be cheaper. It's expensive because A, the price is high. You have a higher price stock, the options are going to be higher. And B, the implied volatility is high. People know the stock moves. When implied volatility is high, the options altogether, they get more expensive. But all your friends are trading Tesla. What are you going to do? You're going to just not trade it? You're going to buy out of the money calls and hope for the best? You're going to paper trade it? What you're going to do, we're going to do debit spreads. Now, Evan, what's that? Now, with debit spread is when you buy the 885 call and you sell the 890 call. Now, remember, because we sell options, this is credit. And you use that money to buy the 2355. So in reality, when you get your money back and you spend it on the other call, the cost of this trade is only $2.05 or $205, equal to your max loss. So your max loss for a debit spread on this is $205 versus $2,355 for max loss here. Is it too good to be true? In a way, yeah. Because if the stock's at 885 and it goes up, your profits stop at 890. So you're making money as the stock goes up, right? But because you sold the 890 call, you make no more money. So it's kind of like a covered call where you own 100 shares and then you sell a call above it and you collect, the difference. The beauty is you could substitute that 100 shares with just buying one call. If you didn't have that, buying the call, and you just sold this naked, that's seen as unlimited risk, and that would cost more because the margin requirements would cost more. So that's the debit spread. You buy the lower strike and you pay for it by selling the higher strike. There's also, you'll hear about credit spread, which is the opposite, where you sell the 885 and you buy the 890. But we're done with Tesla. So debit spread, and it could also be on the put side as well. So simply put, debit spread, you buy the at the money call and you sell an out of the money call. And if it's puts, it will be the opposite direction. So if it's a $10 put, right, you would sell the $5 because you want the stock to go down. So you're playing it that direction. So the next low cost option strategy is the butterfly. So with butterfly, you buy one call in the money, sell two calls at the money, and you buy one call out of the money. Remember, when you sell calls, you collect the money, and you use that to buy the other wings. So let's say the 19 strike call is 175, the 1950 call is $1.50, the 20 strike call is 129. Now, since this is two, since you bought sold two of these, that's a $3 credit, which you could use to buy this and this. And altogether, the cost of this trade is $4 or 4 cents times 100 equals $4. Now, it looks something like this, the profit. This is a loss over here, loss over here. If it goes too much, this trade is for like low implied volatility. If you don't think the stock's going to move crazy, then this is a good trade for you. Because you'll make money if the stock stays in between the 19, where it stays in between where you bought the first call and the second call. Right? This is all money range. Money, money, money. Now the big money comes right here at the 1950. If at expiration she's at 1950, that $4 is like $45, but it has to stay right here at expiration, at 1950 at expiration. So if you know how to find the sweet spot, butterflies for you. Debit spread, Butterfly. If you're broke, ENJ Cap.